Welcome to Lesson 7 of TradePhantoms Foundations of Trading. I'm Mr. Black, and in today's lesson, we are going to be talking about trends, how to understand what a trend is and how it's established, control points, and multiple time frame correlation. So let's get into it. First, let's talk about the bare bones basics of a trend. To establish an uptrend, you need to be establishing higher highs and higher lows. So if you look over here to the left, you can see we are establishing higher highs, corrections to higher lows, impulses to higher highs, corrections to higher lows, impulse higher high, correction to higher low, and so on and so forth. And that's how you establish directional movement. Downtrends are of course determined by establishing lower highs and lower lows. So here I have a lower low, I have a correction to a lower high, another lower low, another correction to lower high, another lower low, and so on and so forth. Another parameter for establishing a trend is you must have at least 3 directional segments for a trend to be established. So it's not enough for me to just have one big impulsive move upwards. If I do not have any corrections in that impulse, all of that would be considered one segment, and I will not have a trend established. So for me to establish an uptrend, for example, it's not enough for me to just have a bunch of big green candles in a row. I need to have an impulse, a correction, and an impulse. So I would need to establish a higher high. With my impulse, I would need to correct to a higher low, and then establish another higher high to have an actual uptrend established. Same thing for a downtrend. I would need at least 3 directional segments to establish a downtrend. I would need to establish a lower low, a correction to a lower high, and then another lower low. So besides the 3 directional segments, another parameter of trend is you must break past the control point of the previous trend if there was one. And I'll show you what that looks like on a chart in just a few slides. If you do not have clear directional movement, if you are not establishing higher highs and higher lows or lower highs and lower lows, then you are in a consolidating or sideways non-directional market. And that can look a few different ways. It could be something as simple as you simply ending the previous trend by breaking past the control point, so you haven't established a new trend as of yet. Or it could look more range bound as we see here in figure 1, where price is not really establishing directional movement, we're just kind of bouncing back and forth. Or here in figure 2, where you can see where we have these ascending or descending lines converging towards a central point. So if I have points converging towards one central point, that's called a pennant. If I have an ascending or descending line, as we see here in figure 2, then that is called a wedge, where price is not really establishing directional movement. We are not establishing higher highs and higher lows. We are converging towards a central point, consolidating the market. To understand control points, you need to understand how trend moves and how control points move as trend is established. So let's look at this downtrend here on the left. Here we have a very clear downtrend. We are establishing lower lows, lower highs, lower lows, lower highs, and lower lows. Every time I establish a new low in a downtrend, in other words, every time I break past the previous lower low, the moment I candle close past the body of the previous lower low, I'm determining a new controlling lower high. And then every time I correct back from a new low, I'm determining a new controlling lower low. So let's take this example here. The moment this red candle closed below the body of the previous lower low, instantly the highest point between the 2 previous control points became the controlling lower high. And then this point was the active lower low. As soon as we corrected back from the new low, that became the controlling lower low. And as long as we remained between these 2 control points, we were still in our downtrend. Now the moment this red candle closed below the new lower low, instantly the highest point between the 2 previous control points became the new controlling lower high. And then whenever we corrected back from a new low, that became the new controlling lower low. So what this shows you is as you establish new lows in a downtrend, you are determining new controlling lower highs, and as you retrace back, as you correct back from these new lows in a downtrend, you're establishing controlling lower lows. Same thing if you have an uptrend. Every time you establish a new high in an uptrend, you're determining a new controlling higher low, and every time you pull back from that new high, you're determining a new controlling higher high. So control points are constantly shifting as to the most recent controlling lower high and controlling lower low in a downtrend, or controlling higher low and controlling higher high in an uptrend. Why is this important? Well, for you to establish a new trend, not only do you need to establish 3 directional segments, you also need to end any previous trend if there was one. So if you already had a trend established and you were correcting back from that trend, from the impulse on the trend, unless you manage to break past the control point of the trend, a new trend cannot be established. So let's look at what that looks like on a chart. So here, I'm telling you already ahead of time, we had a downtrend over here. We were establishing lower lows, lower highs, lower lows, lower highs, and lower lows. This was the last controlling lower high of this downtrend. And this was the last controlling lower low of the downtrend. Then we reversed direction and we established 3 directional segments. We established a higher high, a correction to a higher low, and then a higher high. The moment this green candle here candle closed past this controlling lower high here, instantly the downtrend ended. Because you can't have a downtrend with a higher high. That breaks the definition of what a downtrend is. So the moment this green candle here closed, that was the end of that downtrend. Now, where do you measure the new trend from? Well, you measure the new trend from where the previous trend ended, and the previous trend ended at its last control point. So the last control point for this downtrend was this controlling lower low. So what has happened since the end of that downtrend? Well, we've established a higher high, an impulse, a correction to a higher low, and another impulse to a higher high. So we had an impulse, correction, impulse. 1, 2, 3 directional segments, and therefore we have established a trend reversal with an uptrend here. And that is what a trend reversal looks like. So you have to have 3 directional segments, 1, 2, 3. You also have to break past the control of the previous trend if there was one. Those are the 2 parameters for establishing a trend. Let's talk a little bit more about multiple time frame analysis and correlating structure. When professional traders are looking at the charts, we're always looking at a minimum of at least 3 time frames to get good clarity and refined structure for our entries. In some cases, these different time frames can overlap, especially in terms of their order blocks, and these can provide opportunities where we have stronger levels of multiple time frame correlation, confluence, right? So let's take an example here on the right. Here, this big green box in the background is the monthly level. Now we are currently on the daily candles. So these are all daily candles. Each one of these candles is 1 day of trading. But this big green box in the background, what's marked monthly, was drawn on the monthly time frame. And that was an area of institutional buying on the monthly level. This middle green box here that says weekly was an area of institutional buying on the weekly time frame. And then finally we drilled down to a lower time frame here on the daily, and we saw an area of institutional order flow here on the daily time frame. And you can see that all 3 time frames overlap each other here, where the daily overlaps with the weekly and overlaps with the monthly. And that is an area of multiple time frame correlation. If I have multiple banks and institutions buying at or near the same price point, the area in which their order blocks overlap each other will form an even stronger level of imbalance. It's like a Venn diagram of unfilled orders. Even more unfilled orders sitting in this area in which all 3 time frames correlate. This is why I keep my zones semi-transparent when I'm looking at the chart. It's so I can see the overlay. And you can see how this works brilliantly when we're looking for trade opportunities. We had multiple banks and institutions buying here at this price point where all 3 time frames correlate. So when price came back in and retraced, it hit that massive pile of unfilled orders sitting at this area of multiple time frame correlation. And because there was such a strong imbalance in order flow, price immediately rallied back upwards. And that's where we would look for an opportunity for an entry so that we can trade together with the major financial institutions. That is it for lesson 7. If you would like to learn more about trend, I'm going to link in another YouTube video where we talk about trend much more in depth. It's a 35-minute video where we're just talking about trend and control points. That does often take people multiple views to really understand fully. In lesson 8, we're going to be talking about technical analysis, fundamental analysis, and how to use them as confirmation. So we'll be doing a deeper dive into technical and fundamental analysis and how to use that properly in correlation with institutional order flow with IOF. But that's it for now. Take care, everyone.